1.7 million spent, 1.5 million discount. Nothing went wrong on this deal, and that's what made it expensive. Before we get into this, I want to say something that matters. If you're new to real estate or you've looked at deals and thought, well, I think that makes sense, but I'm not totally sure why, you are not behind. You're actually exactly where most thoughtful people start. This story isn't about being reckless. It's about how something that feels careful can quietly become costly. So I want to start at the end. On this deal, about $1.7 was spent fixing things over time. And the reason everybody liked this deal in the first place was because they thought they were getting a $1.5 million discount. No disaster or collapse happened. And that's the part that makes this worth talking about. This was a 92-unit apartment complex, not luxury, not run down or distressed, just a normal place where people lived because it was close to work and it was affordable. It was the kind of building that doesn't make headlines, which actually made it a good thing. And it was reasonably priced. It wasn't what people usually call a stable market, which just means that jobs were steady, people weren't living in waste, and most importantly, rents didn't jump all over the place. The asking price was just under $9 million. Quick flash of nearby properties, other buildings just like it, same size, same feel, have been selling closer to 10.5. And in that moment, everybody in the room felt the same thing. And you don't need a finance background to feel what it means. If you've ever shopped for anything, a car, a house, even a flight, your brain does the exact same thing. You see the same thing, lower price, and you immediately think there must be value. And that's exactly how it felt in the room. When you break it down per apartment, what people call price per door, which is just the total price divided by the number of units, it came out to be about $97,000 per unit. And in that area, similar places were selling closer to $115,000. That gap felt meaningful. The broker didn't hype it up. In fact, that's why everybody trusted it. The owner have held the building for a long period of time. Some upgrades have been delayed. Most of the work they said was inside apartments, things like flooring, paint, kitchens, minor things. They mentioned the roof, it still worked. They mentioned the heating and cooling systems, they were running. So in other words, nothing felt urgent. And when people looked at rent coming in versus expenses going out, it didn't rely on big assumptions. Rents were about $125 lower than similar buildings in the area. So the idea was to slowly raise rents over time as units turned over. No aggressive promises. So on paper, the deal looked reasonable. And this is the kind of deal people relax into. So they bought it. The first few months after closing felt exactly how you'd hope. People paid rent, apartments stayed full, monthly income and expenses reports were boring. And if you've ever been responsible for anything, a business, a team, even a household budget, you know this feeling. It's not excitement, it's relief. And then something small started to change. It wasn't enough to panic, but just enough to notice. More maintenance requests started to come in than expected. That means that tenants were asking for repairs. A few invoices from vendors felt higher than you thought they would be. A roof repair that seemed bigger than what a minor fix usually means. Again, nothing scary, it was just more. And if you're watching this, there's a very good chance you would have reacted the same way. You sort of normalized it. And here's where I want to slow down. This moment of almost everyone responds the same way. You explain to yourself and you say, well, this is normal with older buildings. You say things like, there's always some cleanup when you take over, or this is exactly why we didn't pay top dollar. And all of this is reasonable, but there's something subtle happens internally. You start opening the monthly reports sooner when they come in, you read it a little bit more carefully, and you ask more questions on the call. And then around month 9, the insurance renewal comes back. And let me tell you, when insurance costs go up, it usually means the company thinks the building is riskier than before. The premium, which is the amount they had to pay, was up almost 40%. Nothing happened. There was no claim, no increase. In other words, it was about the building and condition of the building itself. And soon after, a roof inspection came back. The roof technically still worked. It wasn't leaking anywhere, but it was old enough that insurance and the banks were no longer comfortable with it long term. So replacement estimate, $650 grand. And then the heating and cooling systems were reviewed more closely. Many were what they call it past their useful life. That just means they're older than what's considered reliable. They might work today, but failures become unpredictable. Estimated exposure around 400,000. And here's where people get confused. The building was still operating, money was still coming in, no one was calling it a bad deal yet, but the safety cushion was already gone. And by the second year, the issue wasn't just one big problem, it was timing. There wasn't one big expense. It was about when they all started showing up at the same time. Units took longer to turn over because fixes went deeper than paint and flooring. Electrical panels that were previously acceptable started raising questions from lenders. And units sat empty longer. Not because people didn't want them, but because they weren't ready yet. Money was still coming in, but savings, that cushion reserves that you had, were being used up. And by the end of year 2, about $1.7 million had been spent fixing and replacing things. And this is the quiet moment where the realization finally lands. The reason everybody liked the deal, that $1.5 discount, was already spent. And it was spent because the building needed it. This is the part most people don't see coming. Some improvements are choices. You decide when to do them. You decide how much to spend. And maybe they make something better than it was. But other aren't choices. They're just obligations. You can delay them, but you cannot avoid them. And the building decides the timing and not you. So when several of those obligations just suddenly showed up around the same time, the building didn't ask if the timing worked for you, it just started collecting. So the money you thought would build a momentum ends up acting like padding, just absorbing problems instead of creating progress. And this is how smart investors buy broken buildings. Not because they're careless, but because broken buildings don't look broken. They look reasonable. They look discounted even. They look like something patience and effort should be able to handle. Until one day, you look back and you realize that nothing technically failed, and yet the deal never became what you thought it would be. This is exactly how smart investors end up buying broken buildings. Drop a comment below. Was there something that you bought that you regretted it 2 years later? Let's chat, and we'll see you on the next one.